Okay, so you're welcome to another class. And today we are going to start a very short but a very important standard, which is IAS 10 on events after the reporting dates. Note that this class comprises of is a combined class because this is a combined requirement for across levels. It's just the way questions are set that are different, which you would see very soon. So we're looking at IAS 10 on events after the reporting dates. So the first thing we really need to establish for this standard is the objective of this standard. And the objective of this standard, there are two. It's two objectives we want to achieve for this standard. Number one is when, in fact, let me put it as to identify when an entity should adjust its financial reports for events that occur after the reporting date. That's the first objective we want to achieve. And that's the first thing we want to know as far as IAS 10 is concerned. When can we adjust our financial reports for events that occur after the reporting dates? And the second objective is disclosures, to identify disclosures that are necessary for events that occur after the reporting date. So two objectives we have. First is to identify where an entity should adjust its financial report for events after the reporting dates. And secondly is the disclosures that are necessary for events that occur after the reporting dates. So these are the two things we want to learn today. Now, before we look at events or when we adjust, we have to adjust our report for events that occur after the reporting dates, there are certain terminologies that we need to identify first. Okay, Mr. Christopher said I should zoom in. Okay, I think it should be okay this way. Okay, so there are certain terminologies that we need to learn. The first one is events after the reporting dates. What do we mean by events after the reporting dates? So you see, these are events either favorable or unfavorable that occur between the reporting dates and the dates when the financial reports are authorized for issue. So events after the reporting dates are events whether favorable or unfavorable that occur between the reporting dates and the dates when the financial reports are authorized for issue. So the second one is reporting dates. I want to believe that this one is very clear, which is why I'm not emphasizing so much on it. We are still going to go to those events, but as the name implies, events after the reporting date. So when we say after, it has to have a limit. That after need to have a closure. And that closure is the date when the report are authorized for issue. So the reporting date, this is the year end of the entity, and the authorization dates, this is the dates when the directors or the board of directors approves the financial reports. It's not even the day when shareholder approves it. It's the day when the board authorizes or approves the reports. There are some instances where when the board approves, they would report to the shareholders. They will present the report to the shareholders, or there are some companies that might have a supervisory council within them. They might present it to those people, but that's not the authorization date. The authorization date is the date when the board of directors approves the financial reports. That date is the authorization date. So whatever events that occur between that reporting date and the date where the reports are authorized for issue, that is the coverage of IAS 10. That is what we call events after the reporting dates. Now, there are two types of events after the reporting dates. We have adjusting events and we have non-adjusting events. So the adjusting events, these are events that provide further evidence of conditions or situations that exist at the reporting date. These are events that provide further evidence of conditions or situations that exist at the reporting date. Ufoma, you know that you can talk if you want to, so I can get your questions clearly. Because I believe I've already explained what you're asking again. Ufoma, are you there?
So when you say authorized for issue, what does that mean?
So you would usually sit down and approve the financial statements. So that is when they authorize it for issue. Right? So when the board of directors, especially for a quoted company, when they approve the financial statement. They will have a sitting that, okay, we want to approve the financial statement. So it is when they have approved it that it's now authorized for issue. Okay. So, or let me say, or when financial or the authorization dates, or the authorization dates. So the date when they authorize it is the date when it is authorized for issue, which is the date when the board of directors, people that are managing the company, when they approve it, that the auditor have signed it, they then append their signature on it. That is the date it is authorized for issue. That is the authorization date. So, and the reason why we sometimes call the date of authorization as the date it is authorized for issue is because that is when you can then publicize the financial reports, either to the shareholders, to the public, or other stakeholders as it may require. That's what we mean by when the financial reports are authorized for issue. What I mean is the authorization dates.
Clear, sir. Thank you.
Okay. So the adjusting events, I said these are events that provide further evidence of conditions or situations that exist at the reporting date. So we'll look at series of examples of adjusting event. I will show you a lot of examples very soon. But by this definition, so by this definition, these events, they only show us that the situation at the year end, these events only confirm what was existing at the year end, but which probably maybe because of lack of information, we did not know. It's just like probably maybe there is a customer that was owing us so much money, and the guy has not paid for a long time. So at the end, we were still hoping that he will pay. But the guy he has been owing us. So a little after the end, but before the authorization date, the guy, we had information that he has gone bankrupt. We had information that he has gone bankrupt. You see, this is an adjusting event because the fact that now we now know that he has gone bankrupt only confirms the conditions that was already existing, only confirm that this guy had already been bankrupt. This guy does not have money to settle. Or there was a court case that we had made a provision for that, in fact, we didn't even know whether we should make a provision or not. That a court case has been going on. A little after the reporting date, they came and said that we need to settle, that we lost the case. This again only provides evidence of the condition that we were going to lose the case. These things has been existing at the end. So this event only confirms it. It has been existing. It was true at the end. They had already existed, just that we did not have sufficient information at that date. We will look at further examples very soon. But adjusting events are events that provide further evidence of conditions or situations that exist at the reporting date. While non-adjusting events, so these are events, it's just the opposite of this, that does not provide evidence of conditions or situations that exist at the reporting date. Conditions or situations that exist at the reporting date. Okay, now let's look at some examples to strengthen our understanding. Now, I would want somebody to read for us here. Do we have Femi, Ifo? Either of you can help us.
Example 1. The management of an entity completes draft financial statement for the year 31st December 2017 on 28th February 2018. On 18th March 2018, the Board of Directors reviews the financial statement and authorizes them for issue. The entity announced its profit and selected other financial information on 19th March 2018. The financial statements are made available to shareholders and others on April 1st, 2018. The shareholders approved the financial statements at their annual meeting on 15th of May 2018. And the approved financial statements are then filed with a regulatory body on 17th of May 2022.
This is supposed to be 2022, yeah. No, 2018. Made a mistake. No, now let's analyze this together. If you look at this question, the reporting date is 31st of December. The reporting date is 31st of December 2017. So even though this report was completed, so the management completes draft financial statement for this period, they completed it on February, meaning probably that was when the auditors finished their work. But the reporting date is not when they completed the report. The reporting date is the year end, meaning that's the closure for all transactions. 31st December. That's the reporting date. Now, what is now the authorization date? Or the date it is authorized for issue, which I can simply call authorization date. So is it 18th of March, which is when the board of directors reviews and authorizes them for issue? Or is it 19th of March, when they announced its profits? And or is it 1st of April, when they presented it to the shareholders? Or is it 15th of May, when the shareholders approved it? Or is it 17th of May, when it was filed with the regulatory body? Based on my explanation of authorization dates, can anyone tell me what the authorization date is among all these dates?
18th
18th
March
March
2018.
Fantastic. Thank you very much. It's as simple as that. It's when the directors approved it, when they authorized it for issue. Femi, read the next one.
On 18th of May 2018, the management of an entity authorized financial statement for issue to its supervisory board. The supervisory board is made up solely of non-executives and may include representatives of employee and other outside interests. The supervisory board approves the financial statements on 26th March 2018 The financial statements are made available to shareholders and others on 1st of April 2018. The shareholders approved the financial statements at their annual meeting on 15th May 2018. And the financial statements are then filed with the regulatory body on the 17th of May 2018.
Okay, thank you. So again, for this one, the management authorized the financial statement for issue to its supervisory board on the 18th of May. The supervisory board are non-executive directors, and they include representative of employees and all of that. So the supervisory board approved the financial statement on 26th of March. So they then gave it to the shareholders on 1st of April. Then the shareholders approved it on 15th of May. They filed it to the regulatory body on 17th of May. So what's the authorization date here?
18th May.
15th of May. Okay, so whatever it is, the details they give us, we should focus on when the management authorizes it for issue, or when the management approves it, or when the board of directors approves it. Okay, now the second part here is adjusting events. Examples of adjusting events that we have here is when there is settlement of a court case. So a settlement of a court case is giving evidence that we already are going to lose the case from the end. And the settlement confirms that there was an obligation we were owing at the end. So in this case, we might need to adjust our provision that we might have made. We will need to update it to show the actual amount that we are now settling. Or probably we will need to cancel out our provision or update it. If the settlement would happen much later in the future, but I mean, we need to settle. So for that reason, we will need to adjust that provision. You see, in the exam, when they want to ask you questions on IAS 10, the examiner is not going to be asking you to adjust the report. The examiner will ask you, should they adjust it or not? That's the focus of IAS 10. IAS 10 is not how to. No, IAS 10 is should you or should you not? Is it an adjusting event? Is it not an adjusting event? That's what IAS 10 basically wants to address. Another one is bankruptcy of a customer. I also mentioned this also, that when a customer goes bankrupt after the year end, but before the financial statement are authorized for issue, or before they are authorized, that is also an adjusting event, because it shows that in fact, it confirms that at the end, that customer must have been facing serious financial difficulty. So going bankrupt after the end only confirms that, because people don't just go bankrupt. You won't just wake up and say, I don't have money anymore. No, it's something that would have been going on gradually. You will have been in financial distress. Then ultimately say, well, let me just declare to the public that I cannot pay my debt anymore. So if that happens, you would need to adjust the receivables of that year, of that previous year. You will need to, it's an adjusting event. Also, is sale of inventory. So if you sell an inventory after the year end, what that does for us is that it's going to provide evidence of the selling price of that inventory. According to IAS 2, inventory is measured at the lower of costs and net realizable value. If we now sell our inventory after the year end at an amount that is lower than its cost, we need to go and adjust that previous year report so that the valuation of our inventory will reflect that valuation. It needs to reflect, because the fact that we are now able to sell it at an amount, at a selling price, it only confirms us, it only helps us determine the net realizable value of that inventory. And that will help us in our valuation. So we will need to adjust our inventory valuation. It is an adjusting event. Another one is discovery of frauds or error. If frauds or errors are discovered after the year end, that shows that our financial statements were incorrect, we will need to adjust figures of that previous year, especially if that fraud was discovered before the authorization date. You will need to update that previous year figures. Whatever item it is affecting, that fraud or error has affected, it needs to be adjusted. It is an adjusting event. Okay, Emmanuel?
Yes,
Go
sir.
ahead.
Yes, sir. Thank you. Yeah, this adjusting event that is limited to when before the authorization date. Now, what of if this normal adjusting event actually happened and it was covered after the authorization date? Are we going to leave it? I think it's no, but I don't know what to do.
So you just treat it in the current year. You update whatever figure in the current year, whatever item is it affecting in the current year. So the discussion here is, should we adjust the previous year figures or not? That's the discussion. And you can only adjust if that event happens between the reporting date and the authorization date. If it happens after that date, that means you are not going to adjust your previous year figures. You won't adjust the financial statement of the previous year. You would only just update the report for the current year. You just include
Oh,
it as part of your transactions for the current year.
thank you, sir.
All right. Ufoma.
So I have a life scenario,
Okay,
like
please.
where I work, our 2024 financial statements. We find out that so many of the transactions were not treated, figures were not corrected, and the auditor have audited it and management has approved. But what they told me that I should go and update it, as in post these transactions for 2024. So I want to ask, how can I treat this transaction? Should I backdate or I should treat it in this current payments that were not posted, some were wrongly posted? So at times I'm doing reversal. They were not posted to the right entries. So I don't know how to correct this, and it's really a challenging thing to me. So I just kept them aside. But the auditor was saying that I must try and do it so that when they are auditing us for 2025, I don't know how it will, I don't know. So I need help. Thank you.
Yeah, so good question. So first is based on what IAS 10 is saying, if that event was discovered, if it's an error and is discovered after the date the financial statement is authorized for issue, so that is now outside the scope of IAS 10 because ordinarily errors is an adjusting event. But if it is happening after the date financial report is authorized for issue, then you cannot treat it in line with IAS 10 anymore. You take it away from IAS 10 and you go to IAS 8. So IAS 8 deals with corrections of errors. Okay, so IAS 10 tell you that is it an adjusting event? Is it a non-adjusting event? So errors are adjusting events in as much as you discovered it between the reporting date and the date is authorized for issue. Now, based on your question, you said they have already approved the reports. So we are going to take the corrections away from IAS 10 and you're going to give it to IAS 8 to undo. IAS 8 then says that when an error is discovered affecting a prior period, IAS 8 says that you are going to correct that error retrospectively. You correct retrospectively, and correcting retrospectively is just you will not go and adjust the previous year account anymore. You cannot touch that anymore. So you are only going to correct it by adjusting the opening balances of assets, liabilities, or retained earnings. Assets, liabilities, or equity. Let me put it equity generally. Depending on the nature of the item so that we will know which one is affecting. But we cannot go and change figures of the report. We have already, as soon as the report is approved, nobody touches it anymore. It's there to be like that. Okay. But IAS 8 now takes it. IAS 8, I will teach you IAS 8. I will show you examples of how to do these corrections. I'm sure that when I teach you that, you'll be able to apply that knowledge to that issue you're having in your office. So you will see how to correct these errors even in real life, because most of what we are discussing here is highly practical. It's what happens in real life. So from my hope, did I answer your question?
Okay, sir. Thank you.
All
Yeah,
right.
sorry, I want to say something, please.
Okay, Moses.
With regarding this particular correction, I had a counter with one of the audit firm recently. I think we concluded our 2022 audit year, and there was a particular evaluation we did for that year. It was SS, but they closed it. The auditor in charge, I think the manager in charge then was about resigning, so he didn't look into the revaluation very well, so he closed the audit. So on getting to 2023, they found out that one of our companies was going into PIE. That's the revenue was above 100 billion. So they decided to look into everything detailedly. And so they found out that the evaluation we did in 2022 was overstated. It was beyond what they could close. So the partner called my CFO and said, okay, fine. They have to restate it based on the fact that they don't want another company to look into it because the group is going into PIE sector, another audit firm will come in. So what we did at the end was that we actually did a restatement based on that error. So we created a particular financials. But at the end of the day, when we closed 2023, we ended up restating our figures for 2022, and that was how we closed the error that we found out.
I didn't know I was muted. So again, IAS 8 would actually help us with that. So when you say you restated it, that would be in line with IAS 8 on how to make such corrections of errors. So there is, when we look at with retrospective restatement of of your previous year figures, but when you're restating it again, the way it works, I don't know how you guys have done it. You are not supposed to go and adjust that account they have approved. It's going to be done in this current year, because when you're preparing the account of the current year, you will do that of current year and that of the previous year. You will do the current year and the previous year. So it's in the current year reports that IAS allows you to do that restatement. Okay, so
That's what we did. That was what we did. But we
yeah,
just there was a note anyways. Just that's
yeah,
just
yeah, okay, good. So I think that's fine. That's fine. Okay, so with all these examples we're having, what we need to identify here is this. When it comes to errors, as soon as, like for your company, for your firm now, if that has been identified before it was approved, okay, before the financial statement was approved, we can easily change figures of that previous year. But if we now identify it after the reports were approved, then we can't do anything to that anymore. Then IAS 8 takes over the affairs, right? So, and at that point, everything you want to do, the retrospective restatement or the retrospective application of the correction of errors is going to be done in the current year. And usually we would adjust the opening balances that we're bringing forth, depending on the nature of that item. If it's an item affecting asset, equity, and all of that, you'll probably be adjusting it from your equity statements. Then you would do your retrospective application or corrections that. So, I mean, when we look at IAS 8, it's another very interesting standard that we would be able to enjoy. Okay, good one. So another one is we receive information affecting asset values in the sense that we got information after the year end that our asset is impaired. Okay, so like a decline in the fair value that existed before the year end, but we didn't know. We only got that information after the year end. We can go ahead and change figures again, provided it's not outside the authorization date. Also, determination of purchase or sales consideration. So when you are only able to determine the selling price or the purchase price of an asset after the end, an asset that you bought or that you sold before the end, but you are able to determine the purchase price after. I mean, if that happens, then you can then adjust your report with that new information. So I have seen a question before that asked you to mention 3 examples of adjusting events. So you need to be able to mention at least 3 or 4 in the exam. Now, for non-adjusting event, like you have mentioned, this one, they are events that does not provide evidence of conditions that exist at the year end. They don't show that these events were happening at the year end. In fact, non-adjusting events are majorly new events. They are new transactions that happen for the year that you don't need to go and adjust the previous year reports, as it were. And examples of that is if there is a major business combination or if there is a disposal at the end. This is a non-adjusting event. You don't need to adjust your report for that because it's happening. It's a new transaction that is happening. Or maybe there was a natural disaster or fire that occurred maybe in our factory after the reporting date. That is a new, nobody know that fire was going to occur. Nobody planned for that. It's a new transaction. It's a new event. Or the value of our investment fell, maybe because of government policy or because of economic circumstances. These are new transactions. These are new events. Or the prices of our inventory fell, again, because of probably government policies or because of a new competitor. These are non-adjusting events. Or we declared dividend after the year end. So a lot of people would think we need to go and adjust the previous year report. No, if you declare dividend after the year end, is a non-adjusting, is a new transaction, is a new event. If you decide to declare dividend, even though dividend is paid from the profit you must have made, so usually it is based on cash flows, it's based on retained earnings, not a particular profit like that. You will see a company making loss. Maybe they made loss in the previous year and they still pay dividend. So probably they have made so much, they have buffer in prior years. So announcement of dividend, take note of this. You can ask you. So you need to know that they don't need to adjust the financial report of the previous year for this. It's a new transaction. It's a new event. Dividends are paid from your cash flows, from your retained earnings. So you don't have to adjust the prior year figures for dividends. Another one is when you issue shares or debts in the current year. It has nothing to do with the prior year, or there is a business restructuring, whether you close a segment, you change management, is a non-adjusting event, or there's changes in tax rate or laws. They are non-adjusting events, or there was a lawsuit that came up, is non-adjusting, is a new transaction, or you introduce a new pension plan for your employees or a new share option scheme for them, is non-adjusting. Or you had that a customer has gone bankrupt, but this one is as a result of a sudden event, as a result of a disaster that happened to that customer, or as a result of a regulation that is affecting that customer. As a result of that, he had to go bankrupt. It was a new transaction or event that happened. Not that nothing changed. He just came and announced that he has gone bankrupt. But it was very visible that he was struck by a disaster. He was struck by a policy that affected his business suddenly and resulted in him going bankrupt. That is a non-adjusting event. Also is when we have new events that can affect the going concern of our business, is also a non-adjusting event. That goes to show that if the going concern is as a result of prior year's events, that means it might be adjusting. We might have to update. In fact, we will not be able to prepare our report on a going concern basis for the prior year. But if new events like a pandemic or we lost a key government contract, new events is what is strengthening our going concern, then that is a non-adjusting event. New events, new transactions, new happenings. These are non-adjusting events. Okay, so do we have any questions before I move on to... I saw a hand up. Suraju, you wanted to ask something? Any questions? Okay, now I've
Sorry.
given you...
Sorry, I want to ask a question. When we said adjusting event, we said there is a if we are able to sell a product at the beginning, maybe after the end of the accounting year, then we notice that the actual price in the market is lower than what we have our inventory, that we should adjust. But what also there is also a significant fall in the market. Like maybe we have other people who trade in our product, but there's a fall in the market for that one where you said significant fall that we should not adjust. So I see those two very close and can be confusing.
Okay, yeah, I get your point. So it won't be confusing, I assure you of that, in the sense that for this one, so the fall in prices is as a result of new events, like a new competitor that happened this year. It's a new event. I mean, if they are going to ask you in the exam, they will be very clear. They will be extremely clear that this fall in prices is because of government legislation. This fall in prices is because of a ban. This fall in prices is because of a competitor that came in this year. So in that case now, it has nothing to do with previous year. It's not indicating any condition that exists in the previous year because it's a new happening. But this one that we were talking about sale of inventory, where we're able to sell our inventory at a low price, now us knowing the selling price of that inventory in such a way that it's not like anything happened, nothing happened. Things were, we cannot point to this is why there was no new events that affected those prices. It just came. That shows that was the price that was existing, just that we did not know. At the end, we did not know. It was now when we now sold it that we are now aware of the selling price. And that's the challenge, right? Why this is important is that most people, when they are valuing their inventory, at the end, they don't go out to the markets. They don't go. People abuse IAS 2. They abuse it. They won't go. They will just use the costs. They will just use the costs. Because who has time to be going and be asking, okay, how much is this price today? How much is this inventory today? So people don't go. They won't know. They will just assume that the selling price will be higher. So what we are now saying there that, okay, if you now sold that inventory immediately after the year end, you now saw that selling price, we are selling it for a low price, then go and adjust your inventory valuation. Go and adjust it. So that's different from this one. That's because like there was a policy. I mean, if there's a government policy, everybody will know. If there's a new competitor, everybody will know that this is why prices are falling. Then that one, you know that one is non-adjusting because the event is happening this year. It's a new event. Okay, Lukman, is it clear?
Yes, thank you very much.
Okay, so I did a summarization for you here, just for you to see a comparison between adjusting and non-adjusting. So I won't go through them again. You can there are things I've mentioned before. So just a summary of, okay, of the same thing, litigation, when it can be adjusting, when it can be non-adjusting. You will see for the ones that are non-adjusting, things that occurred, like fraud that occurred after the end, like a contract that came up after the end. Like, I mean, we are talking about new transactions, new events. Is not events that shows that this thing has been happening. It's not event that is confirming that this thing has been, that this was the case at the end. Those are adjusting events. Okay, and I've mentioned going concern regarding non-adjusting. And I told you that for going concern, if new events like a government policy, like a sudden disaster happened that affected our business, and that will not threaten our ability to continue to operate. If it is a new event that occurred, then that is non-adjusting. But if this event shows that if nothing happened, we announce that we cannot continue to operate, and we're not going to be able to prepare our report of the previous year on a going concern basis. We will have to prepare it on a breakup basis. Okay, so if we determine that we want to liquidate, because it's something that would have been occurring, just that we were not just facing reality. So if a going concern is not as a result of a new disaster, a new adverse circumstance that occurred, if it's just a determination that we want to liquidate, and we are determining that after the end, is an adjusting event. It is an adjusting event. And an example is this. So after the reporting date, okay, the reporting date is December. So at that date, the entity is trading profitably and the management expect that to continue to do so. They have no intention to liquidate the entity or to cease trading. But in March, before the financial statement authorized for issue, they experience an unexpected change in the business, unexpected change in the business circumstance, and they put the entity into a voluntary liquidation, right? So in this case now, for this, we would need to, let me hear from you. How are we going to prepare our reports in this case? Is it going to be on the basis of, will it be on a going concern basis or on a breakup basis?
On a breakup basis.
Okay, yeah. So, okay. Let me hear another opinion on a breakup basis. Okay, it is on a breakup basis. So anytime an entity's determine after the reporting date either that it intends to liquidate or cease trading, that it has no realistic alternative but to do so, then that means that report of that prior year we need to state it clearly. We need to restate a lot of our figures on a breakup, that on the assumption that we might not continue to operate. It's important that they know. It's important that users are aware. Finally, is in the notes to the account, an entity must conspicuously show the date when the financial statements are authorized for issue. The date of authorization must be stated very clearly. And also, if there is any update on disclosures about condition at the end of the reporting date, like contingent liabilities, for example, that I taught you in IAS 37 that we usually disclose. If there is an update about that disclosure, so we need to put it in the notes, the accounts, that there is a new information about these contingent liabilities, and also material non-adjusting, all those non-adjusting events that happened between the reporting date and the date the report were authorized for issue, that are material. We need to also disclose them in the notes, even though they are happening after the end, but it has to be disclosed in the notes to the report. So the notes are based on these three bases, and I explained them for you. Now, I have some questions that we need to solve here. So the first one is that they said, which of the following is an adjusting event under IAS 10? A, declaration of dividend after the year end, bankruptcy of a customer due to condition existing at the year end, acquisition of a new subsidiary after the year end, issue of new share capital after year end.
These are bankruptcy of a customer due to condition existing at year end. The condition already exists before the year end, so it is adjustable, sir.
Correct. Number two, a company's financial year ends on 31st December 2004. On 10 January 2005, the company settles a court case relating to an event that occurred on November 2004. The settlement confirms the company had the liability at the end. How should this be treated? A, adjust financial statement for 2004, disclose only, ignore as it is after the reporting date, recognize in 2005.
We have to adjust the financial statement for 2004, sir, because this event already exists before the end of the reporting period, sir.
Okay, that's correct. That's correct, because the company, they settled the court, the event has occurred since November. So even though the settlement is happening in January, it only confirms what was existing at the year end. Okay, that's correct. Also, they said, which of the following is a non-adjusting event? Discovery of fraud, so 2004 transactions, sale of inventory after the year end, providing evidence with lower NLV. There is a fire on 5th of January, and there was a settlement of litigation relating to an accident, which is a non-adjusting year.
See, sir, fire in the factory on 5th January, destroying asset, because it is not a thing we are expecting before the year end, sir. So it came after the year end. So it
Okay.
is C, sir.
Okay, that's correct. That's correct. Also, they said under IAS 10, when should dividend declared after the reporting date be recognized as a liability? Always at the year end, only if declared before the reporting date, only when paid, never.
When declared before the report.
Sorry, Lukman, what did you say?
Only
when
if declared before the reporting date.
That's correct. That's correct. Only if declared before the reporting dates. Okay. Now let's look at some other scenarios. Now they say that Kogi Limited year end is 31st December 2004. On 15 January 2005, one of its major customers declared bankruptcy. The financial difficulties of the customer exist throughout 2004. How should Kogi's Limited account for these events? Let's see that. How should they adjust? How should they treat it? How should they account for it?
Surely it is an adjustable event, sir, because throughout 2004, throughout the year that got ended, we already know that they have financial difficulties, sir. So it is an adjustable event, sir.
That's correct. So you will account for it as an adjusting event. Also, we have Delta PLC had inventory of crude oil valued at 50 million at 31st December 2004. On 10 January 2005, the government banned certain oil exports, causing prices to fall drastically. Should Delta adjust its 2004 financial statements? Why or why not?
Non-adjusting events.
Cannot adjust, sir. They cannot adjust because this event happens abruptly. It is not like we have been experiencing it in the previous year under review, sir.
So this is a non-adjusting event because it is as a result of a government ban that's affected prices. Okay. Another one, the directors of Ogun Limited declared dividend of 30 million on 20th January 2005 relating to the year ended 31st December 2004. Should this be recognized as a liability in 31st December 2004 financial statement?
No,
No. Okay,
non-adjusting events.
that's correct. So dividend declared after the year end is a non-adjusting event. And the financial reports of the previous.
I have a question.
Okay, please ask.
I think when I was in foundation, I think sometime in, I think few years ago, especially about this particular declaration of dividend, I was told that if a dividend is declared, it can, and as long as it is not paid, it can only be taken in the notes to the account. That was that year. But until last year and this year, that was when I began to understand that when a dividend is declared in a particular accounting year, as long as even if it is not paid out yet, it has to be declared as liability. So I don't know whether I was one that got the misconception previously, or there was a time that that principle was changed. The first principle I had was around 2019, 2020, thereabouts. That was when I had that knowledge that, okay, if a dividend is declared, as long as it is not paid out, it has to be taken note of in the notes to the account. But in recent time, 2020, 2023, 2024, 2025, I began to get another worldview that, dividend declared, if as long as it has been declared for a particular financial year, you just have to declare liability for it until when it's paid out, then you pass the normal journal entries to close that liability.
Yeah, so what changed is that before, when dividend is proposed, when a proposed dividend, we don't usually, so they put it in the report, just proposal. So when IAS 1 was adjusted around 2017, not even 2017, a long time, around 2010 or so, they changed that no, when dividend is proposed, you can only declare that. You only put it in the report as liabilities when it has been approved by shareholders. And that is when they declare dividend. So when you say dividend declared, it means it has been approved. So management proposes, so the management will propose. So when shareholders approve, then they declare. At that point, there's no going back, right?
Okay.
So that's when we put it in our reports when it's declared. So that was what changed. IAS 1 actually changed that.
Okay. Thank you, sir.
Yeah. Okay. So let's look at these 3 questions, then we can go. So Femi, can you read this for us?
Okay. When I read two notes to our financial statements, they seem to contradict each other. One of the notes refer to a legal case from December 2004, in which we were being sued for damages by a customer. We originally thought Omega would have to pay damages of 5 million naira, but the case was finally settled for 5.5 on 20th October 2005. The financial statements at 30th September 2005 presented a liability of 5.5 million. Despite this only being confirmed after the year end. The second note refers to the major fire in one of our factories on 15th of October 2005. The damage caused to the factory is estimated at 5.75 million naira. However, the note says that no adjustments have been made to the amount recognized in the financial statement for the year ended 30th September 2005. In respect of the damage caused by the fire, this will have a significant but temporary impact on the cash flow of the business. However, it will not cause our ongoing concern status to be in doubt. The two events are not being treated consistently, despite the financial amount being similar. Please, can you explain these apparent inconsistencies? Okay. I'm aware that a major customer owing us a significant amount became insolvent on 20th November 2005. We are unlikely to recover much, if any, of this debt. But why don't the financial statement contain at least a note explaining to our shareholder what has happened? I am aware that the financial statements were authorized for issue on 15th of November 2005.
Okay. So for this one, you should find it easy because I believe we'll have mentioned everything. So they give us, these are 3, each paragraph is dealing with different events. If you look at the first event, this guy was saying that he said the event after September, 30th September, meaning their reporting date is 30th September. So he said he was reading their notes and he saw some contradictions that he said the note referred to a legal case from December 2024, which is during that last year, which were being sued for by a customer. So they said they originally thought that they would pay 5 million, but the case was finally settled for 5.5 after the end, which is 20th October. So the financial statement at September, at the end, already included the 5.5 million. despite this only being confirmed after the end. Okay. So can anybody comment on this? Can we explain to this guy why this has happened? Or is it wrong for this to have happened? Or do I need to explain the scenario again? Can anyone
No,
respond?
it's correct to have included it because it's an event that has occurred in the normal accounting year of the organization, and it was also included before the authorization. So it is correct to have included it.
Okay. Okay, yes, they are correct. Even though the company's year end is 30th September, and they settle the liability for 5.5 million after the end. So the guy was surprised that, why are we now putting the liability in our books at 5.5? How did you know? So all they had done was they have adjusted their report for the prior year because settlement of a court case after the year end, but before the financial statement was authorized for issue. Thankfully, the report was authorized for issue in November. So the settlement of the court case of 5.5 million is an adjusting event because it provides evidence of conditions that exist at the end. This amount shown in financial reports is in order. Okay, so it is an adjusting event. The second one, he said he saw a note relating to a major fire of their factories after the end, which is 15th of October, and they had a loss of 5.7 million. And the guy now saw that they did not adjust the previous year financial statements ending in September 2005 of that year in respect of that damage. So the guy is now saying that this amount will cause significant cash flow impact on the business, even though it will not affect their going concern, but it will affect cash flows. He's now saying that these two events are not being treated consistently. He said, this one, we settled a court case after the end. We adjusted it. This one, fire happened in our factory after the end. We did not adjust it. Then he's asking us to explain why the inconsistency. So the fire outbreak is a non-adjusting event that does not provide evidence of conditions that exist at the reporting date. This type of transactions cannot be adjusted in the financial reports. Hence, the inconsistency that is noticed is as a result of with the requirement of yes time. Okay. The next paragraph says that I'm aware that a major customer owing us a significant amount became insolvent on 20th of November. We are unlikely to recover much, if any, of these debts. Why don't the financial statement contain at least a note explaining to our shareholders what has happened? Can anyone respond to this?
Yes, sir.
Okay.
This is
Okay, go ahead.
no, go ahead, go ahead.
Okay. It is not a non-adjusting event because
Exactly.
it became insolvent after the authorization. So the account has already been approved by the board. So the adjustment will be in the coming year, not in the previous year.
Okay. That's absolutely correct. So the insolvency of the customer occurred after the authorization date. Hence, it cannot be adjusted in the reports of the prior year. So it's outside. In fact, this is not an event by the reporting date. It does not meet that definition again. It does not meet that definition again. Because it's happening after the reporting date. So this is an ICAN question. They say that IAS 10 on event after the reporting date, reporting period has two main objectives: to identify or specify when an entity should adjust the financial statement for event that occur after the year end, and to specify disclosures that should be given about events that occur after the year end. So required, discuss the following: event after the reporting date, adjusting events, non-adjusting events. Without copying any notes, can anyone tell me what is event after the reporting date? Without looking at your notes, what is
Can I
event
try
after?
to?
Yes, Omar, please try.
Okay, these are events that could be favorable or unfavorable that happens after an approved date. I'm just trying to say it offhand now, not looking at my book. So I don't know if I'm correct with that explanation.
No, you're not, except you want to try again.
Okay, there are events that occurred after a reporting date, and this event could be favorable or unfavorable.
You're still not correct.
Ah,
You're missing a key ingredient. Can anyone correct her?
okay, now let me try again. There are events that are either favorable or unfavorable. I think they occur between the reporting date and the date of which the report has been authorized for issues. I think something like that.
Now you're correct. Now you're correct. So, who can tell us adjusting events? Can explain adjusting events?
Okay, so adjusting events will be those events that occurred between the reporting date and the date when the financial statements are authorized for issue.
Again, can you repeat that again?
Okay, there are events that occur between the reporting date, which is the end of the accounting period, and the date when the financial statements are authorized for issue.
What's the difference between that and event after the report? So you are saying the same thing. All you have to find is event after the reporting date, not adjusting events.
Okay, can I try on this?
Yes, please.
I think there are events that occurred as they provide evidence of events that happened, I think, after the reporting date.
Say it again.
There are events that they provide evidences of what happened or the situations that happened at the reporting date.
Now you're correct. Yeah.
Okay.
Yeah, that's correct. So they give us more information. These are events that give us more information. They give us more evidence. They help us confirm situations or conditions that were already existing, that were true. They were there at the reporting date. They were there. So this event just confirms them. They really confirm them. So non-adjusting is now the opposite of that. This one, they do not provide any further information. These ones, they are new events, new transactions that occurred in that year. They are new. Okay, this is good for revision for us. So if you look at the requirement of this, they say we should prepare a brief memorandum advising the directors of Shaka Nigeria Limited on the accounting treatment or disclosure required as a result of 1 to 3 after the reporting date. So for this one now, so they say prepare a brief memorandum. So please help them do their memorandum. And this is what is required. You need to do something like this. So let's say you are the accountant director of Shaka Nigeria Limited. Accounting statements. Okay. Now, they said shortly after the financial year ended 30th June 30th, 2018, but before the financial statement were authorized for issue, Shaka Nigeria Limited inventory were destroyed by fire outbreak, which resulted in a loss of 200 million. Who can respond to this? How should we treat this?
It's a non-adjusting event since it happened after the financial year end.
Okay. So the following paragraphs explains the accounting treatments of the events specified in a question. The fire outbreak is a non-adjusting event because it does not confirm conditions that exist at the reporting dates. The 200 million loss will not be adjusted in a prior year, but in current. Secondly, this talks about the company's financial year ended June 30th, 2018, shows an amount of 60 million that is due from one of his debtors, Mr. Onigbese. Shaka Shaka Nigeria Limited provided for impairments as of June of 50 million against the gross value of 60 million due from Onigbese. On July 2018, before the financial statement was authorized for issue, Onigbese declared bankrupt and unable to pay the debts. Who can respond to this? How should we treat this?
I think it's an adjusting event since Mr. Onigbese has been declared bankrupt before the date the financial statements were authorized for issue.
So how do we treat it?
Increase the impairment to 60.
What do you say?
I said we will increase the provision to 60 million. That's to be treated as bad debt written off.
Okay, it's an impairment for receivables. So the trade receivables should be completely written off by increasing the impairment provision from 15 million to 60 million at the reporting date. This is an adjusting event, and it provides evidence of conditions that exist. Okay, and finally, it says Shaka Shaka Nigeria Limited was sued on June 30th, 2018, but the judgment was only handed down on July 21st, 2018. The company was found liable for damages and costs amounting to 31 million were awarded against it. On July 22nd, Shaka Shaka Limited filed a claim with its insurers. On July 29, 2018, it was notified that the insurer would only cover 26 million of the loss. How do we treat this? Can anyone respond to this one?
Okay, let me try.
Okay, go ahead.
Okay, I think it is a non-adjusting event, right? And so since the insurance company has taken over 26 million naira of the loss, of the amount filed against Chaka Chaka Limited. So Chaka Chaka Limited will take care of the balance of 5 billion naira.
Which makes it adjustable now.
Sorry?
So it's adjustable.
I said, which makes it adjustable.
Yes, it's adjustable.
Oh,
Because this loss, they were sued before the year end. So, and also, when they gave them the penalty, as the fine of 31 million, so they will have to adjust for the difference.
for the difference. Okay, yeah, I think you're right with that.
Because luckily for them, there's a coverage already from the insurance company, meaning that their own liability is going to be less now, unlike if they've not even insured the situation at all. So it is adjustable. That's my take.
Thank you. However, so the good thing is this, our year end is this, Abi. So there was a judgment after the year end, and we found liable, we're supposed to pay 31 million. So because I want to assume that the dates, let me rely on this for the authorization dates as July 31st. So if the authorization is July 31st, and this judgment was made in 2021, and we're supposed to, yeah, it was made in 2021. So it's an adjusting event. So the judgment depth of 31 million should be adjusted in the financial reports ending June 30th, because it is an adjusting event. So the entity should make a provision equivalent to the amount. Additionally, the entity has filed a claim to the insurance company before the financial reports were authorized for issue. And was it approved on July? Okay. And the insurer has also notified us of a 26 million coverage. Of a 26 million coverage. Hence, we will adjust the reports ending June 30th by recognizing an asset in respect of the amount recoverable of 26 million. Okay, so what I've been able to do here is that I did not offset. I did not offset because offsetting is not allowed in this case. You need to present the assets and the liabilities separately. And I think I told you something like that in IAS 37. Under provisions, where there is reimbursables, when you're expecting a reimbursement, I told you that you should present it separately as an asset, as amount recoverable. So the 31 million, you're going to make a provision for that amount. And since the insurance company, since you filed the claim and the insurance before the date the reports were authorized for issue, and the insurance also have assured you that they will cover you before the report were authorized for issue, then that means you can adjust the report ending June, and recognize an asset in respect of the amount recoverable of 26 million. Do you know that if the insurers did not respond until after the date after the reports were authorized for issue, he cannot update these reports with these assets. He cannot recognize an asset if the insurer responded after the date the account was authorized for issue. The only reason I'm able to update and adjust is because I'm sure that I will get the money because they already notified me that they will cover 26 million before the authorization date. So fine, I can adjust. If it had been after the authorization date, I cannot adjust. I can only go and put it in the current year report. I will not be able to adjust the prior year report with this amount. So you need to be very wary of that. And I think that's what this other ones is also testing. We'll look at it now. So I hope the above explanation have clarified the treatment of the events that the reporting dates. Thank you. Okay, and finally for today, this one says that, okay, you know what? Let me give you this. Let me not solve everything so that you also have something to practice with. Why don't you practice this yourself and get back at me? Let's see what you can come up. What you can come of it. So we have tried for today. We're going to stop here.
Thank you, sir.
Yeah, so for my SBR students, we're going to meet on Wednesday, and we're going to round up IFRS 15. For my FR students, we had already concluded IFRS 15 because what you are supposed to know in IFRS 15 is not as deep as for SBR. So we are going further for them. So where I stopped with you guys, I had to go further with the SBR students. And that place I'm covering for them is where ICAN usually asks their own exams. And but for you guys on Friday, we are going to be starting leases. So I think after lease, we will then move to group accounts for both levels. But group account for FR is very different for group account for SBR. Group account for SBR is much, 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 much more advanced than whatever you guys are going to be learning. So all through September, we are going to be having this 8 to 10. You just have to make this sacrifice because I'll be so busy in October. And what I'm trying to do for my FR students is that I want to finish your syllabus by the end of September. If we do this 8 to 10 for FR, we are going to finish your syllabus by the end of September. Now, what is left will be very little, if any, safe, because we will have been able to cover more ground. So today, we are not going to have that our 7 to 9 class, but from next week, Sunday, we are going to have this morning class and that evening class. So September will be a lot of work for you guys, and I would advise you to endure so that you will do well in your exams. Like I promise you, if you endure and you follow through, all things being equal, you should pass. And I can tell you for free Students that pass through me, I don't get less than between 90% to 95% pass rates. All my students know me. Yeah. Even when they see me at the center, they come and meet me at that. I passed your own course. I've passed your own course. I don't, you won't pass under me and fail. I don't like that because I put in 100%, over 100% for you. I put in all the effort required, and I always ensure that you also put in the same effort. I don't like failure. It's not nice to fail. Leave those motivational speakers. It's not good to fail. If you have opportunity to pass, 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 do it right the first time. There's nothing better than that. Don't fail. So, and that's the mission, yeah. So please, let's make the necessary sacrifices. Let's do assignments. Let's revise. The diet is now officially halved. We are moving to the second half. We are moving to the second half. So, I mean, we are now here. So, try to enjoy the rest of your Sunday, and I'll see you in the next class. Thank you very much.
Thank you, sir.
Yeah.